Let me begin with a question that sounds extreme, only because we are trained not to ask it what happens when the money system itself becomes too large to be stabilized. We are approaching a moment in global economics where inflation is no longer a temporary imbalance, but a structural outcome. The figure often cited, $90 trillion, does not represent a single bill, a single country, or a single policy mistake. It represents the accumulated weight of global debt, monetary expansion, and financial promises that now exceed the productive capacity of the real economy. History tells us that when this imbalance reaches a certain scale, currencies adjust not gently, but violently. For decades, economic growth has been sustained not by rising productivity alone, but by expanding credit. Governments borrowed to avoid political pain, corporations borrowed to boost returns, and households borrowed to maintain living standards. Central banks facilitated this process by suppressing interest rates and expanding balance sheets. The first hook we must confront is this debt-postponed crisis, but it also magnified it. What was once manageable at lower levels becomes destabilizing when scaled globally. Inflation in this context is not simply higher prices at the grocery store. It is the systemic devaluation of currency as a solution to unsustainable obligations. When states cannot realistically repay what they owe through growth or taxation, they turn to the least visible option, currency dilution. This process rarely announces itself openly. It arrives through stimulus, liquidity support, and emergency measures, while purchasing power quietly erodes. Those with assets adjust. Those who rely on wages do not. Here is the second hook that deserves attention. Inflation is not neutral. It redistributes wealth. Asset holders, those who own stocks, real estate, and financial instruments, often see values rise alongside inflation. The middle class, whose wealth is concentrated in income rather than assets, absorbs the shock. Savings lose value. Fixed wages lag behind prices. Debt becomes harder to service as daily costs rise. This is how inflation destroys the middle class, without a single law being passed against it. The next currency crisis will not resemble past collapses defined by hyperinflation or overnight currency failures. It will be more subtle and more damaging. Multiple currencies will weaken simultaneously, forcing people to realize that the issue is not mismanagement in one country, but fragility in the global monetary system itself. When confidence erodes across borders, capital moves rapidly, volatility increases, and central banks lose the illusion of control, another hook lies in scale. $90 trillion in combined public and private obligations cannot be resolved through conventional tools. Raising interest rates risks collapse. Cutting spending risks social instability. This leaves policymakers trapped, choosing between visible pain now or hidden pain spread over time. Inflation becomes the political compromise, precisely because it obscures responsibility while transferring costs downward. The defining economic reality of our time is not volatility, recession, or even inflation in isolation, but scale. Global public and private debt has expanded far beyond the growth of real productive capacity, creating a structural imbalance that conventional economic tools can no longer resolve. This is the first hook that must be confronted honestly. Debt has not merely increased, it has outgrown the economy that is supposed to service it. For decades, debt was treated as a bridge to future growth. Governments borrowed to stabilize economies, corporations borrowed to enhance profitability, and households borrowed to sustain living standards. As long as productivity, population growth, and technological expansion kept pace, this system appeared sustainable. But that relationship has broken down. Productivity growth has slowed. Demographic trends have weakened labor expansion, and technological gains increasingly concentrate wealth rather than broadening output. Debt, however, continued to compound. Here is the second hook: compounding debt grows exponentially, while real economies grow linearly. This mathematical reality is often ignored in political and financial discourse, yet it is decisive. Interest obligations alone now consume significant portions of government revenues in many advanced economies. At the corporate level, balance sheets depend on low rates not as a convenience, but as a condition for survival. At the household level, credit substitutes for wage growth that never arrived. This imbalance exposes a deeper illusion embedded in modern economics: the belief that financial claims can expand indefinitely without corresponding increases in real production. Financial assets represent promises on future goods and services. When the volume of promises vastly exceeds what the economy can realistically produce, adjustment becomes unavoidable. The system must either default openly or devalue quietly. Historically, societies choose the latter. Another hook lies in political constraint. Repaying debt through taxation is politically destabilizing. Cutting spending threatens social cohesion. Allowing defaults risks financial contagion. These constraints leave policymakers with shrinking options. As obligations grow larger relative to output, the range of viable responses narrows. Debt ceases to be a policy choice and becomes a structural trap. What makes the current situation particularly dangerous is its global synchronization. This is not a problem confined to one country or one currency. Major economies have expanded balance sheets simultaneously, creating a world where financial excess is systemic rather than localized. When productive capacity cannot catch up across the system, the adjustment mechanism shifts from growth to currency value. This is why inflation should not be viewed as an unexpected malfunction, but as a predictable outcome of an economy where financial expansion has outrun its real foundation. The imbalance between debt and production is not cyclical. It is cumulative, mathematical, and increasingly irreversible. Inflation is often presented as an unfortunate side effect of economic shocks, policy mistakes, or temporary supply disruptions. That explanation is comforting, but incomplete. In periods of extreme debt accumulation, inflation functions less as an accident and more as an instrument. This is the first hook that must be understood clearly. When obligations become too large to honor honestly, currency devaluation becomes the quiet solution. Modern states rarely announce that they are reducing the value of money. Instead, inflation is reframed as stimulus, support, or stabilization. Central banks expand balance sheets to preserve liquidity, governments run persistent deficits to sustain demand, and policymakers assure the public that price pressures are transitory. Yet beneath the language lies a consistent outcome. Each unit of currency purchases less than before, reducing the real value of existing debts. Here is the second hook: inflation resolves political impossibilities. Raising taxes sufficiently to service massive debt loads risks electoral backlash and social unrest. Cutting spending threatens essential services and economic stability. Explicit defaults undermine financial credibility and trigger systemic crises. Inflation, by contrast, distributes losses gradually and diffusely. No single decision appears responsible, yet the adjustment occurs nonetheless. This process is deeply asymmetric. Debtors benefit as obligations shrink in real terms, while creditors and savers absorb the loss. Governments, as the largest debtors in the system, emerge as primary beneficiaries. Corporations with pricing power adjust revenues upward, preserving margins. Asset owners often see nominal values rise alongside inflation. Wage earners and fixed income households, however, experience declining purchasing power with limited capacity to adapt. Another hook lies in expectation management. Once inflation becomes embedded, it reshapes behavior. Consumers spend faster to avoid higher future prices. Firms raise prices preemptively to protect margins. Financial markets demand higher returns to compensate for currency risk. These responses reinforce inflationary dynamics, making reversal increasingly costly. Policymakers then face a dilemma: tightening risks collapse, easing entrenches devaluation. Inflation also alters the moral framework of economic governance. Responsibility becomes obscured. Unlike explicit taxation or default, inflation operates without legislative votes or public consent. It erodes wealth silently, often affecting those least able to hedge against it. This quiet redistribution allows systems under strain to persist longer than they otherwise could, at the expense of social trust. What emerges is not a failure of policy, but a choice shaped by constraint. Inflation becomes the path of least resistance in a system burdened by excess promises. It is politically survivable, administratively manageable, and economically corrosive. When viewed through this lens, persistent inflation is not evidence that policymakers have lost control, but that they are exercising the only control left to them. Inflation is often described as a general rise in prices, but that description hides its most consequential function: redistribution. This is the first hook that deserves attention. Inflation does not affect all groups equally. It systematically reallocates wealth within society, favoring some while quietly eroding others. Understanding who gains and who loses reveals why prolonged inflation reshapes class structure rather than merely altering price levels. At the center of this process is the distinction between asset-based wealth and income-based stability. Asset holders own resources whose values adjust upward in nominal terms as currency weakens. Real estate, equities, and other financial instruments often rise alongside inflation, preserving or even increasing real wealth. The middle class, however, derives its economic security primarily from wages and savings, both of which respond slowly, if at all, to rising prices. This asymmetry creates a built-in disadvantage. Here is the second hook: inflation punishes discipline. Households that save, budget carefully, and avoid excessive risk discover that the purchasing power of their accumulated earnings declines over time. Meanwhile, those with access to leverage and assets benefit from rising nominal values and reduced real debt burdens. The economic system quietly signals that prudence is costly and speculation is rewarded. Wage dynamics intensify this imbalance. In theory, wages should rise with prices, maintaining purchasing power. In practice, wages adjust slowly due to contracts, labor market frictions, and weakened bargaining power. By the time wage increases occur, inflation has already absorbed much of their value. This lag creates a persistent squeeze on middle-income households, forcing greater reliance on credit to maintain living standards. Another hook lies in the erosion of social mobility. Inflation raises the cost of entry into asset ownership. Housing prices rise faster than incomes, investment capital becomes more expensive, and education costs escalate. The middle class finds itself trapped between rising expenses and limited opportunities to convert income into wealth. What was once a pathway upward becomes a treadmill. Inflation also reshapes risk tolerance. As cash loses value, households feel pressure to move into financial markets, often without sufficient knowledge or protection. This exposes them to volatility they cannot absorb. Losses, when they occur, are not merely financial setbacks, but threats to long-term security. The most damaging aspect is psychological. Inflation undermines trust in the social contract. When effort no longer guarantees stability and saving no longer preserves value, confidence erodes. The middle class begins to perceive the system as rigged, not through ideology but through lived experience. Over time, this perception alters consumption, investment, and political behavior, leaving deep and lasting economic scars. Central banks are widely portrayed as omnipotent institutions, capable of stabilizing economies through technical expertise and independent decision-making. This perception itself is the first hook worth questioning. The reality is far more constrained. Central banks operate within a narrowing corridor of viable choices, where every available tool carries destabilizing consequences. Their authority appears strong, but their freedom is limited. Interest rates illustrate this trap with precision. Raising rates is the traditional response to inflation. Yet in an economy saturated with debt, higher rates threaten systemic failure. Governments face exploding debt, servicing costs, corporations confront refinancing stress, and households struggle with higher mortgage and credit payments. A rate hike intended to cool inflation risks triggering recession, financial instability, or outright crisis. The tool still exists, but its safe range has vanished. The second hook lies in the opposite direction. Keeping rates low or expanding liquidity avoids immediate collapse, but it accelerates currency debasement. Asset prices inflate, inequality deepens, and inflationary expectations become entrenched. Central banks are then accused of fueling bubbles and eroding purchasing power. This is not a policy error. It is the consequence of being trapped between inflationary pressure and deflationary collapse. Balance sheets reveal the same dilemma. Quantitative easing was introduced as an emergency measure, yet it has become structural. Once markets are conditioned to abundant liquidity, withdrawing support becomes dangerous. Financial systems built on cheap capital cannot easily adapt to scarcity. Every attempt to normalize policy destabilizes markets, forcing central banks to retreat. Control becomes reactive rather than directive. Another hook emerges in credibility. Central banks rely on confidence more than force. Their guidance shapes expectations, but repeated reversals weaken trust. When inflation persists despite assurances, credibility erodes. Markets begin to test central banks rather than follow them. Policy announcements lose impact, and volatility increases as actors anticipate intervention rather than stability. Global coordination further limits autonomy. Major central banks cannot act independently without triggering capital flows, currency volatility, and financial contagion. Tightening in one economy strengthens its currency while destabilizing others. Easing to maintain competitiveness fuels global inflation. Each decision reverberates internationally, constraining unilateral action. Perhaps the most revealing constraint is political. Central banks may be institutionally independent, but they are socially embedded. Policies that threaten employment, asset values, or government solvency provoke backlash. Over time, this pressure shapes behavior. Central banks do not lose control suddenly, They surrender it incrementally, adapting policy to what the system can tolerate rather than what theory prescribes. In this environment, central banking becomes crisis management rather than economic stewardship. The illusion of control persists because acknowledging its limits would expose the fragility beneath the system. Currency crises are often remembered as national failures, attached to a single government, a single central bank, or a single political decision. That framing is comforting because it implies isolation and containment. The first hook is that the next crisis will not fit this pattern. It will be global in character, unfolding across multiple currencies at once, not because of synchronized mismanagement, but because of a shared structural vulnerability. For decades, the global financial system has operated on interconnected balance sheets. Trade, capital flows, reserve currencies, and debt markets are tightly woven together. When one major economy expands credit, others respond to avoid currency appreciation or capital flight. This dynamic has produced a world in which monetary excess is not an exception, but a coordinated condition. The result is a fragile equilibrium maintained by mutual accommodation. Here is the second hook: confidence, not solvency, anchors modern currencies. Most major currencies are not backed by tangible assets, but by trust in institutions, stability, and relative strength. When inflation erodes purchasing power across multiple economies simultaneously, confidence does not migrate, it weakens everywhere. There is no obvious safe haven, only varying degrees of exposure. This creates a unique form of instability. Capital flows accelerate not toward safety, but toward perceived short-term advantage. Exchange rates become volatile as investors and institutions attempt to outrun depreciation. Central banks intervene, but intervention in a globally inflationary environment loses effectiveness. Defending one currency requires policies that may destabilize others, reinforcing the cycle. Another hook lies in reserve currency dynamics. The dominance of certain currencies has long provided a buffer against crisis, allowing issuing countries to export inflation and borrow cheaply. But reserve status depends on credibility. Persistent inflation, rising debt, and political polarization weaken that foundation. As confidence erodes, diversification accelerates, subtly at first, then rapidly. This shift does not eliminate risk, it redistributes it. The global nature of the crisis also complicates coordination. International institutions were designed to manage localized shocks, not systemic devaluation. Policy responses become fragmented, reactive, and competitive. Countries prioritize domestic stability, even when such actions worsen global conditions. This fragmentation deepens uncertainty and amplifies volatility. Perhaps the most destabilizing element is perception. When households and firms recognize that currency weakness is not confined to distant economies, but present at home and abroad, behavior changes. Long-term planning erodes. Contracts shorten. Investment horizons narrow. Economic activity becomes defensive rather than productive. The next currency crisis will not announce itself with collapse, but with normalization of instability. When volatility becomes routine and confidence remains fragile across borders, the crisis is no longer an event. It becomes an environment. The middle class occupies a uniquely exposed position within inflationary systems, not because of lack of effort or discipline, but because of structural placement. This is the first hook that must be confronted directly. The middle class depends primarily on wages, salaried employment, and modest savings, all of which are slow to adjust when currency value declines. Unlike large asset holders or highly indebted entities, the middle class has limited insulation against monetary erosion. Inflation undermines income stability through timing. Prices respond quickly to currency expansion, while wages respond slowly, if at all. This lag creates a persistent gap between earnings and expenses. Housing, healthcare, education, and energy costs rise ahead of compensation, forcing households to absorb losses quietly. The adjustment does not arrive as a single shock, but as a continuous squeeze that reshapes daily economic decisions. Here is the second hook: the middle class is overexposed to fixed systems. Mortgages, tuition plans, insurance premiums, and retirement contributions are structured around assumptions of monetary stability. Inflation breaks those assumptions. Real debt burdens may decline in theory, but cash flow stress increases in practice as living costs rise faster than incomes. What appears beneficial on balance sheets feels punishing in lived experience. Asset access further deepens vulnerability. Inflation raises the nominal price of assets, particularly housing and financial instruments. For the middle class, this creates a barrier rather than a buffer. Entry into ownership becomes more expensive just as savings lose value. The result is a widening gap between those who already own appreciating assets and those who must rely on income alone. Another hook lies in retirement insecurity. Pension systems, whether public or private, struggle to keep pace with sustained inflation. Returns fail to match rising costs, and benefit adjustments lag behind reality. Years of careful planning can be undermined not by market collapse, but by gradual currency erosion. This risk is often underestimated because it unfolds slowly. Without dramatic headlines, inflation also alters behavior in ways that carry long-term consequences. As trust in monetary stability weakens, households are pushed toward risk, taking simply to preserve purchasing power. Participation in volatile markets becomes less a choice and more a necessity. Losses in these environments are not recoverable setbacks. They represent permanent reductions in security. The most profound vulnerability is psychological. When stability feels unattainable despite compliance with economic norms, work, saving, planning, the social contract phrase, the middle class begins to disengage, not out of apathy, but out of rational adaptation to an environment that no longer rewards predictability. This disengagement reshapes consumption, investment, and political dynamics in ways that reverberate far beyond economics. The coming inflation is not a forecast meant to frighten, but a pattern economics has documented repeatedly. When financial claims grow faster than real production, currencies adjust. The question is not whether this adjustment will occur, but who will bear its cost. If history is our guide, the middle class will not be protected by intention or rhetoric, but by understanding. And in moments like this, understanding is not academic, it is economic survival.